You'll love it.
Let's start.
So I wore my spooky shirt today because we're talking about some scary stuff here.
That's funny.
I had to do it, man. It's scary.
You're gonna
Now look,
celebrate Halloween? What you guys doing for Halloween?
going trick or treating.
Yes, sir.
My
Yes.
son's a dinosaur.
That's dope.
What
That's
about
awesome.
yours?
I think we're gonna be some characters from Toy Story. My wife said she picked it out this year.
Nice.
So we'll see how that goes. I think we're gonna go
Yes,
trick or
sir.
treating on Sunday as well.
Nice. Yo, so you want to get this started?
Yes, sir. Let's go.
Let's do it. There's down payment and there's closing costs. So that's why I wore the spooky shirt, because it's scary. A lot of people don't want to talk about it. I don't really hear a lot of realtors telling their clients about it. So then the lender has to be the bad guy. Say hello to the bad guy. The down payment, you tell them like 5% for conventional, $100,000 is just $5,000. That's all you need. That's true for down payment. But closing costs, they vary from city to state. And I like to use the 5% rule, where 5% of the purchase price is your closing cost. On average, it could be more, it could be less, depending on where you're at, especially depending on the loan program, the property type, the area. So, but one thing I want to make sure we're clear about is that the closing costs are the responsibility of the buyer. The seller does not need to pay closing costs. It can be negotiated, it does happen, but they don't have to. So one thing you want to keep in mind when you're buying a property, buying a home, is that is your responsibility. When you're getting pre-approved, you'll get what's called a loan estimate. And it's irrelevant to shop around the lenders when you're getting pre-approved. You just want to be focused on whether or not you can be pre-approved, because a lot of these fees are third-party fees. The lender actually does not control these fees. They only control the origination and your interest rate. Yeah, everything else is third-party.
What do you mean by origination?
So I'll get into that right now.
Okay, cool.
But basically, it's called a loan estimate for a reason, because it's just that, an estimate. Nothing is set in stone until you're like under contract, and then you're getting like your closing disclosure. But origination fees, there's the loan origination charge, what the lender charges to do your loan, but there's loan underwriting, there's loan processing. There's a lot of people that go into the loans to process it all and underwrite it. So then there's even discount points as well. But before I get into discount points, I do want to mention there's also broker fee if you're getting like a different type of loan, like a bank statement loan or an investor type of product. Some lenders will broker your loan with wholesale lenders to be able to do something like that. And it could be 2 or 3% just in a broker fee. But that's more advanced. We should probably stick to just like talking about residential right now.
Is that kind of negotiable, or as a client?
If you have a good loan originator like me, you can talk to me, reach out to me, and we'll talk about it. But
who are we essentially? Is that like is that broker fee? That's just that's more like a referral fee, let's call it, or like
a broker. Like if some lenders are bankers and some bankers are brokers, and some lenders are a mixture of both, direct to lender and they can broker deals. So when you're getting a deal brokered, it's because you're getting some kind of different product that you can only get through wholesale lenders. And wholesale lenders, they don't lend directly to consumers. They only go through a broker. So you have to go through a broker to get that type of loan.
Okay.
Yeah. But right now we're talking about like just box A, what the lender can control. And the other thing besides just the interest rate and their charges are discount points. Discount points is something that as the buyer you can pay if you want to lower your rate. Depends on what rate you're getting your credit score, but for example, 1 point is 1% of the loan amount, and that'll typically knock it down about a quarter percentage. So to find out if it's really worth it for you, you have to think about how long you're gonna be in that home, because if you're gonna pay $2,000 and you're just gonna knock it down your monthly payment $30, is it worth it? Because it might take you 7 years to make that money back, paying $2,000-3,000 in points. So that's the equation that you have to do to see if it's worth it for you. If you know you're not gonna be in that house for a long time, then it's usually not worth it. Every situation is different. Now I will say this, if you do pay points, that's prepaid interest, and those are tax deductible. So get with your CPA and deduct that in your taxes.
That's cool. I was actually overcomplicating the whole points thing. So I'm glad you just made it that simple.
Yeah. The next thing, since we're talking about closing costs, would be the appraisal fee. I want to get into that. That's something that's paid outside of closing, that's paid up front. And again, the lender does not control the appraisal fee. This is not money that goes to your lender. This goes directly to the appraiser. So usually $500 around there for a single unit family home. Could be $1,500, depends on the type of property, the size. I just did a commercial loan the other day, and the appraisal itself was $2,700. The guy was so mad, but I looked into it, and that's totally different. For commercial properties, it's a big difference, because a lot of more things go into it. But basically, lenders nationwide, we all order the appraisal through an AMC, an appraisal management company. So it's random. It's not like I'm calling my cousin the appraisal, and this is nationwide how the lenders order the appraisal. And
what if a customer has their own appraisal? Can that be used through that transaction?
Like if the customer already has their own appraisal?
Mm-hmm.
No, because the lender has to order the appraisal because it has to go through that. And it's to protect the lender as well as to protect the person who's buying the property to make sure it's worth what they're paying for it. But if somebody's going to lend money for $300,000, they want to make sure it's worth $300,000. They're going to order their own appraisal for that. And that money is non-refundable. Like you can walk away from the deal, but you're not going to get your money back for that because the appraiser is going to go out there and they're going to do their job. They're going to walk through the property. They're going to compare it with 3 other comparable properties, take measurements, take pictures, do an appraisal report. So they're doing their thing. They're getting their money.
I'm trying to pull up our contract so I can go through this with you because I heard you say like Section A.
I'm a professional, man. I don't even have one in front of me. I just know it.
Yeah, I'm sure you look at the bitches.
Yeah. But basically, there's not too many things in the closing costs, but it's just something that I wish more people knew about because when I started, you hear things like you only need 3% down to buy a home, but nobody ever wants to talk about the closing costs, and people get surprised. People get really surprised.
Most of this closing cost fees and stuff like that, do they take it out of like the mortgage that you're getting or the loan that you're getting? Or are these like things that come out of pocket?
Out of pocket. Yep.
So you got to pay this out of pocket and then you get your loan money?
Correct. This is all paid at closing. Your total cost to close will be your down payment, your closing costs, and your escrow. So I'm gonna keep going. After you've paid the appraisal, what's next is the title company fees. the title company is going to charge all their different fees, which there's a lot of, and each title company is different. You know, you can ask title companies to give you like their preliminary CD or kind of like a breakdown of their fees because you can shop title companies, you know. But
Mm-hmm.
it's very important what they do because they're going to make sure that when you're buying this property, it has a clear title with no taxes or any other type of liens on the property. Um, if there is, let's say, an HOA fee, and it's like $30,000 that the seller knowingly or unknowingly, not for us to judge, but they're just selling the property and there's like a $30,000 lien on it that they forgot about. Well, now you, the new buyer of that property, you're responsible for that $30,000 lien. So that's why the title company is very important and they're going to do their job and you're going to pay for that as the buyer. So after the title company, there's the state recording fees, which the state's going to get their money and in everything. At least we live in Florida, so it's not like New York where it's ridiculous, the state recording fees and transfer taxes. But basically, the recording fees is that it's recorded with the county and the state, so it's legal, this transaction. The transfer taxes is next. So transfer taxes.
What before you keep going real quick, can we go
Mhm.
back to the title company?
Yeah.
And then to the recording fees as well. Or maybe at the end you can give us maybe like so I know for a fact that everything is very case dependent. But what kind of fees can people expect on, like, for example, title company fees? What type of fees are you seeing? You can only go based off of what you're seeing. So
Yeah, basically $2,000-3,000.
okay.
That's what I'm seeing. You know, that's here in Florida.
Okay. And then how about for like the state recording fees roughly?
State recording fees could be $300, $500. You
Okay.
know.
Okay. And then now we're down to taxes, you're saying?
Yep. Transfer taxes that can vary as well. In Florida, I'd say it's like 60 cents for every, or $60 for every $100 that you spend. I don't know. It's so weird how taxes work. But
Oh my
all I
God.
know is like I've looked at it and I've compared different states, and I'm just glad we don't live in like New York because it's like 2% right there just for transfer taxes. And Florida's not that bad, but the state's gonna get their money. Now, the next big thing is like prepaid items, which is setting up like an escrow account. An escrow is the way that you're setting up an account for the bank to manage your property taxes and your homeowner's insurance. So you don't have to worry about it. Which is very important because let's say you didn't set up an escrow account and then the tax bill comes due at the end of the year and you don't have that money. That's how you hear about people losing their home, not paying the taxes on it because they didn't set up an escrow account, which you can waive an escrow, but you have to make sure that you're putting like 20% down and you're going to pay an escrow waiver fee. And then you just have to be really responsible.
Is
But
escrow what's how much is an escrow waive fee roughly?
I think it was 0.25% of the loan amount. I want to say it was.
So you have to pay that fee just to tell them that you're responsible enough to pay for your taxes at the end of the year.
Yep.
It makes sense though. I mean, that's technically it's your property, but it's theirs.
Yeah, that's true.
You said 0.25
Yeah,
roughly.
I think that's what it was. It's got to be that or 0.75. I just can't remember which one of the two.
They're both a
But
little hefty fee.
yeah, I know, right? But check this out, okay? This is what is really important for buyers to know that nobody tells them. When you're buying a house, you are going to pay 12 months of homeowners insurance premium up front. I'll repeat, you're going to pay 12 months of homeowners insurance premium up front.
And why is that?
That's just what the insurance company calls for. You have to pay that up front.
And is this only if they're coming with less than 20%?
This is only if they're not waiving the escrow, but I guess you'd have to talk with the insurance company about that. I know every insurance company pretty much makes that happen.
So is this different than the that other little insurance that I forgot the name of it now? PMI?
Mortgage
Something like that.
insurance?
Yeah. It's
Yeah,
completely
this is different. Yeah, this is
Okay.
homeowners insurance. Oh, I see what you're thinking about. You're thinking about how in the mortgage, you're gonna have your principal, your interest, your taxes, and your insurance. And that insurance will include homeowners insurance and mortgage insurance if you didn't put down 20%. Yep.
Okay. So a lot of people don't know that either, that they're actually just paying this little extra insurance. That's money going somewhere. Just
Yeah,
because they didn't know that if they paid 20%, they would be saving that money.
that's true. And what's even crazy about it is that you're paying that insurance, that mortgage insurance, and it's not even like insurance like to protect you. It's like to
Yeah.
protect the lender for like if you ever defaulted, they would still get their 20% if there was damage to their property and stuff like that. But I know when I learned about that too, I was like, I had to read that over like 6 times. I'm like, wait, what?
Yeah, not many people talk about that.
No. So okay, in the escrow, there's gonna be the 12 months of the homeowner's insurance premiums, and there's also going to be anywhere from 3 months to 12 months of property taxes that you're gonna pay up front. And the reason it ranges from 3 to 12 months is because it depends on when you're closing on the house and when taxes are due. So, that's gonna vary for sure.
That makes sense.
Hmm. Now, every year, your mortgage could fluctuate. It could actually go up after closing. Why? Your principal and interest is locked in for 30 years, but your taxes, those are going up. State's not really lowering anybody's taxes because home prices are going up. So if you are like, why is my mortgage going up? It's usually taxes, or it could be insurance.
Yeah.
Because there's so many hurricanes and things like that. Insurance is costing more, but you can shop your insurance company every year. You're not married to them. You can change your
That's
owner's
true.
insurance company.
And even when you have a mortgage on your house, you're still the one picking out the insurance company and stuff, right?
Correct.
Okay. I remember our mortgage went up about like $400 one year, and it was just straight property taxes.
Yeah.
Yeah.
$400 a month.
Yeah.
Damn.
Yeah.
Taxes are crazy. Yeah, like that can really like shock people.
I mean, it's something that a lot of people I think don't budget for. They're just like, okay, 12, let's say they're getting a mortgage and it's $1,300 and it's almost like rent. They expect that to stay there just because they own it now, $1,300 for those 30 years. And it doesn't necessarily work that way. And there's a lot of people, I just want to bring this out since we're just talking about it real quick. And then I don't think we're going to get into it today, but we're talking about it in the office as well, guys. Anybody who is applying for a loan, in my personal opinion, maybe you can talk a little bit more into details about it. We're at a time and place where make sure you guys are getting, I would say, like fixed interest rates, in my opinion. Don't let them fuck you over with some adjustable interest rates because you will get fucked later on by the
I'd
way
say I don't even mess with adjustable interest rates because they can be pretty scary. They really can.
Mm-hmm.
I will say this, in the commercial loan that I just did, it's adjustable and they basically only do adjustable for a commercial.
Sometimes they do
Usually.
adjustable because, well, sometimes they do adjustable because it usually comes in at a little lower right now. So that it
Usually
attracts.
they do adjustable and they do like payment penalties as well because usually commercial properties they don't stay on the books for 30 years anyway,
Yeah.
you know.
Yeah. But
Oh,
I just
but
wanted to bring that up.
that basically sums up like closing costs right there. You've got
So
your origination, your title, your appraisal, your transfer taxes, your recording fees, um, and then your escrow. That sums it
So
up.
overall, would you say the closing costs roughly? It's easy to say anywhere from like $8,000 and up to be
Yeah, I
good.
mean, it just depends on the property type and the loan type, the area, but I'd say I stick with the 5% rule is what I tell
5%.
people. That's what I stick with. Um, which makes a big difference. Like if you think you saved up 3% for your down payment, you're good to go, but you need another almost double that, right?
And I always thought that they took that shit out of the mortgage.
I know that
Or
I've
like,
talked to some people who didn't pay closing costs when they bought their home in like 2012 because the sellers paid it all. And I was like,
mhm.
they want to buy another house now. And I'm like, well, that's not the market we're in right now.
I've actually heard though, like you're one of the first people, and you might be right. I mean, I'll bet more that you're right than I'm right. But I've actually heard that the seller is the one that pays closing costs most of the time.
So I'm just talking about the buyer's closing costs. We're not even talking about the seller's closing costs.
Then the
I don't even
sellers over there have their own closing costs as well.
exactly. The sellers are the
Mhm.
ones who pay all the commission to the
Mhm.
realtors, which is 6% right there of the sales price.
That's
Um,
variable, but yeah.
to be honest with you, I don't even know what the seller's closing costs are. I haven't even looked at that because I don't really deal with that. You would know more than me about the seller's closing costs if you want to go over that.
No, I don't really deal with sellers, to be honest.
Oh, okay.
I've
Well,
said here I don't deal. I've said here that I don't deal with buyers, and then now I just said that I don't deal with sellers. So people are probably like, "Bro, who the fuck do you work for?"
investors.
Yeah, that's my thing. Cap rates and numbers. I don't know about
Oh
closing
yeah.
costs. I don't know about any of those things.
Well, we're doing our
Man, that's
thing.
good to know.
Yeah,
And
bro.
just all these things, do all these things for those that are, because let's bring this up a little bit, just, and I know we said we're not going to make it as long today, so let's bring it up though, because a lot of people nowadays have so much equities in their house that they're just like, the new thing is kind of just cash out and refinance. I feel like it's kind of becoming the popular thing more than it was in the past. um so what is the process when you're doing like a cash out? Is it all the same as when you're getting a mortgage? Are you practically re-getting, like, doing the same exact step? You just own the property from the get-go?
You're doing the exact same thing and more
Mm,
because we're also gonna need just like it's a little bit you already have the homeowner's insurance premium, which is cool. So what happens is like you already have an escrow account established as well. So, all right, if we're talking about cash out refinance, guess what? What you owe on your property is not what your payoff amount is. Your payoff amount, once you ask for it, is going to include like some interest in there and some fees to pay it off. What is a cash out refinance? It's not like you're just kind of basically we're paying off your current mortgage. So there's a payoff amount. That current mortgage will be completely paid off and you're going to have a new loan amount, a new mortgage. So we're going to need your payoff amount and then all the money that you have set up in escrow, it's going to be refunded to you after closing. But in closing, you're going to do the same exact thing where you're going to set up a new escrow. The difference with cash out refinance though is your closing costs, 100% of your closing costs can go into the loan, your loan amount. So you don't have to come out of pocket any money. So it's
Okay.
zero out of pocket. It's not zero closing costs. The closing costs are just added to the back of the loan.
Okay. So that's kind of the question that I was asking you earlier about coming on pocket. So in the
Got it.
cash out refinance, they would take it from the mortgage or from the
You
loan
got
that
it.
you're getting. Okay.
Yep. All your closing costs will just go onto the new loan amount. And then whatever the difference of your payoff amount and closing costs subtracted from your loan amount, new loan amount, that's the cash that goes into your bank.
Okay. And then how long till people have to start paying that loan back? Month one?
So you're gonna always skip a month when you purchase a home or do a refinance. So if you close, um, you're always gonna have 1 month where you're not gonna pay. And it's pretty cool because let's say you have a lease coming up that's about to end. You can buy a home and then it feels like you didn't pay for like 2 months.
Right. And essentially, if you're using it as an investment, you still charging those months. So you have like a month in advance.
It feels like it.
Yeah. That makes sense. Okay. So what else are things besides closing costs that we should look at? I know you mentioned broker's fees, closing cost.
I think that's it. I think that's just what we need the people to know about, provide them some knowledge so that we can know about closing costs. It's not just your down payment, it's your closing cost as well for this episode.
Okay. Sounds good.
And
And
then let us know in the comments what you want the next episode to be,
please, about financing. What are different types of people that you can talk to in financing? Like different,
I
like for
think we
example,
should bring
investors.
in like a good tax person, a
A tax
CPA,
person.
and then maybe
I have help.
somebody you got at a title company. That would be great.
I actually have somebody who that would like to schedule a call, and they own a title company. We had them at the office the other day. So that's cool.
You
Do you want to
should
join
you
those
should
phone calls?
Yeah, I'm down.
Okay, that's cool. Um, awesome. Thank you so much for preparing this information for us.
No problem, bro. It took me like 20 minutes, so thank you.
Oh man, we appreciate it.
I went to
All
the
right, guys.
zoo, came home, got ready, and this is fun, man. Let's keep it up.
Yeah. So, any questions that you guys want to put below, and I'll make sure that we read through them and we answer any questions that we get. And then again, your Instagram or stuff where they can reach you.
It's gonna be Ron Mendez _ mortgage lender. And don't let these spooky closing costs sneak up on you. Now you know if you didn't know.
Yes, sir. Awesome, Ron. Thank you so much, brother.
Thank you for having me, bro. Talk to you, man.
Hey,
We'll link up soon.
sounds good, brother. All right, bro.
Bye.